Well, all right. Well, hello, everyone, and welcome to today's webinar, Specialty Disability Insurance for Physicians. I'm your host, Seth Groff, and I'm joined today with DI expert Ryan Lobo. Ryan, welcome.
Thanks, Seth. Thank you so much. And thank you everyone for joining us.
How are things in New York?
Pretty balmy, actually.
Balmy.
Not a
That's
thunderstorm.
that's what it's like here in Nebraska as well. But in addition to the weather across the United States, today we are going to talk about a handful of DI sales ideas that are often overlooked or underserved in the disability market, and specifically with physicians. And you might be sitting there saying, I don't know, Seth, I'm a little skeptical. The DI market for physicians is pretty saturated, and there is some truth to that. But today we're going to take a look at a couple niches that if you're already selling DI to physicians, you're going to be able to add this to your toolbox. Or if you're kind of sitting there saying, man, I know that there's a lot of physicians out there that buy disability insurance, but it's tough to get into that market. If you focus on these niches, it might be your wedge. To get you in front of some of these clients. So before we get into the sales ideas, I just want to make sure that you understand who we are and I guess who we work for. So you're going to see two logos up in the upper left-hand corner. You're going to see Risk Insurance and Reinsurance and IDU. So Risk Insurance, we underwrite, we market, we administer an impaired risk DI product that is on Fidelity Security Life paper, but we do all the heavy lifting. They just back us up financially. And IDU is a Lloyd's cover holder. So again, we underwrite, we market, we administer products that are not available through the domestic DI market. And we're going to take a look at the specific ones later on in the presentation. But Ryan and I, we work for both. And so, why that's an advantage to you is that sometimes your client might need both of these. Or we can also, take a consultative approach and tell you which product is the best fit for your client specific needs. So, with that, Ryan, why don't we jump to the next slide and take a look at the physician market and why we're having this presentation today. So, you can see here, this is a study that I pulled from the Milliman survey, individual DI survey that was out earlier this year. And you can see that in 2023, 31% of the annualized premium was purchased by doctors and surgeons, right? And so that's the largest occupation of people that buy DI. And so when I look at this, I look at it and say, hey, that's a big piece of the pie. How do we fit in that? How do we work in the market? And we'll show you specifically how both IDU and risk fits into that scenario. But I also like to say, why do physicians buy so much DI? And there's several reasons, but three that I always talk about is number one, they spent a long time mastering their craft, right? They've been in school for a long time. They've invested a lot of money into their education. And so by the time when they get out and ready to earn that good income that they deserve, they realize that, with the disability, it could go away and all that hard work ultimately can be lost. And so, they're willing to, buy DI and they see the need for it. Also, physicians, doctors, surgeons, they also typically have higher incomes. And when you have higher incomes, you're typically more likely to allocate a portion of that income to insurance needs. And so, with the higher incomes are more likely to do it. And then third, doctors see the impact of sicknesses and accidents on a daily basis, right? Every day they work with people that are not only going through physical challenges, but they're also going through emotional challenges and they're also going through financial challenges. And they see it firsthand. And so they know that, ultimately no one's not protected in that, disability insurance makes sense. And so, I think it's a great market. There's a lot of opportunity there. A lot of times, people overlook risk for this market, but we'll talk about where it fits in. So Ryan, why don't we, jump to the next slide and we'll kind of share people with the three areas that we're going to talk about today. So here's how we can help in the physician market, right? You're probably squared away with DI carriers for your standard doctor that's healthy, that's, starting their practice and you're solid there. Where we can help is if you're working with a physician and they get declined due to a health issue, we have a product called Flex DI, and I'm going to talk to you why I believe this is the best solution for most of the physicians that can't get a traditional policy because of a pre-existing health condition. Then we're going to talk about excess coverage. So, when you go out and you look at, participation limits with, the traditional DI carriers, a lot of times physicians' incomes could justify more DI than what they're eligible for in that traditional market. And so, we can come in and put an IDU policy on top of that so that, we're getting them closer to the 60 or higher percent of their income actually protected. And then we're going to take a look at business solutions in case you're working with a physician that maybe they own their own practice or maybe they're a key person in a smaller practice. So we'll look at, buy-sell agreements and also buy sell DI and also key person DI as well. But I'm going to give you a little news flash. All of these topics that we're going to talk about today, they apply to occupations outside of physicians. We just kind of branded this webinar with physicians because it gets people's attention, and the case studies here, will kind of be that medical occupation focused. But all the concepts we talk about today also apply to your high-end executives. It also applies to the lawyers, accountants. You go down the list of occupations out there that typically buy DI insurance, all these are applicable to them. So with that, I want to get into the first topic about what is the best solution for a client if they are declined due to a medical condition. So they have a pre-existing health condition. They apply with the traditional DI carrier, Standard, Principal, Northwestern Mutual, Mass Mutual, whoever it might be, apply for them, and they're declined due to that existing health condition. So I always tell people if you're declined for DI due to health, you have three options. Okay, your three options are to self-insure. You can buy a Lloyd's product, which we do have through IDU, or you can buy a graded product like Risk Flex DI. And before we kind of go through, the pros and cons of each, let's look at what that client was originally sold or would have been sold if they were healthy, right? They would have been sold non-can to age 65, 67. It would have been ONOC definition. And then it probably had some sort of guaranteed insurability rider or increase option rider on that, right? And other riders as well, but those are the main ones that I'm going to, talk about. And there is not a situation I went in there and met with that agent and said, "Hey, you should sell your client, a term product to your healthy client." They wouldn't, right? They're going out there, they're saying, "Hey, you've worked a long, hard time in this, to become a doctor, become a physician, you need the best DI policy available, right?" Well, unfortunately, you have a health condition. It's not available. And so in most situations, I'm a believer, and I continue to say this, I believe Flex DI is the best solution because it's the closest product out in the market that they're going to be eligible for. To what was originally sold. And again, I know I'm kind of selling against myself because we have an IDU product that is for impaired risk, which in some scenarios it might, but I'm telling you, it's a small percentage of those scenarios. And I'm a firm believer that if your client is declined due to a health issue, Risk Flex DI is what I would take a hard look at. And so let's just kind of take a look at the difference between Flex DI and why it makes it, the better solution. So obviously Flex DI is guaranteed renewable to age 67. A Lloyd's policy is typically going to be on anywhere from a 1 to 5 year policy term. Now, what that means is that Flex DI is only underwritten once at the beginning. So even if their health changes or gets worse, they don't have to go back through underwriting. Where on a Lloyd's policy, unfortunately, you do have to go through underwriting every 5 years. And so, this 40-year-old psychiatrist, they got to go through underwriting at 40, 45, 50, 55, maybe 60, depending on when they're going to retire. They already have a heart attack, cardiovascular history. And so, that's a lot of underwriting in the future that they have to go through. So,
Seth,
one of the biggest,
I would say, right, the belief is, of course, everyone wants to get healthier and get better.
yep,
You don't buy disability insurance because you think you're going to get better. You understand the fact that the reality is that your health will probably at least stabilize, if not potentially continue to have some hardships.
yep.
So again, it's not the optimistic view, of course, but it is the realistic view.
Yeah, absolutely, absolutely. So when I talk about Flex, I think that's one of the biggest advantages. From an underwriting perspective, Flex DI, we typically do not order medical exams. We're underwriting that with the application and the APS. When you look at a Lloyd's product, it depends on the cover holder. Again, typically we don't order medical records, but there are other Lloyd's cover holders that do. So it just depends on who you're working with. The other thing I want to point out here is the underwriting decision. Okay. And a lot of times with mild cases of heart conditions, or cancer, and always on, or most of the time on diabetes as well, we actually issue those without an exclusion. Okay. So imagine having a condition where a traditional carrier says, hey, you can't have this because of, you had a heart attack, right? And then you're able to not only get your client a disability policy, but also cover that condition that they were declined on. It's not all the time. We're going to look at, how many, how many health conditions they have in the total picture. But a lot of times we do get those issued without an exclusion on those. And sometimes we're flexible with how we design it, right? Maybe, if we go with a 180-day wait, maybe we can get it without an exclusion, where typically on a Lloyd's policy, they are still going to be excluded. So a couple other, things to point out, mental nervous, Flex DI does have mental nervous benefit. Typically, your Lloyds are going to exclude mental nervous disorders. The benefit resets with Flex DI. So if I, collect my benefit and then I'm back to work for 6 months, I'm actually eligible for that. Again, where with Lloyd's policies, it's a one and done. I mean, once you exhaust that benefit, you no longer have coverage. And then, we'll jump down to the bottom and address the elephant in the room, which is the cost. And I think that, one of the biggest mistakes that agents and even, DI wholesalers make is like when they get a decline, they send them both options. And we do it too. We send both the Lloyd's option and Flex DI as well. But if you put that in front of the client without any context, or if you put that in front of an agent that you're working without any context, they just see two separate premiums. And obviously it is more expensive because of all the reasons that I just went through. But look at the premium on Flex DI. It's $4,123 with a $200,000 income. If you do the math on that, that's a little over 2% of their income. And just to be clear, I think this is a 5-year BP on this, not the 10-year. But still, the industry says that you should spend 1 to 3% of your income on disability insurance, and we're still in that 1 to 3% of the income. But what happens is they look and say, well, I got this, Lloyd's product over here for just a fraction, and there's no context to it. And so, I'm a firm believer that if you're unhealthy, this is your go-to. If they're older, or it's extremely more expensive, or whatever the case might be, maybe look at a Lloyd's. But just remember that this is going to be re-underwritten. That price is probably going to go up every 5 years, unless and so on the Lloyd's option, where the premiums are level with a guaranteed renewable product, unless the company goes and refiles it, which we haven't done. Since we've had a product, and since I think we launched it with FSL back in early 1980s. And so just all the advantage of it, I'm a firm believer that risk flex DI for an impaired risk scenario is the best solution with physicians because it's the closest to what was originally sold to them. So I'll you
And
know,
I'm so sad. Yeah, I would
get
just
off my
tack on
soapbox
there.
now. Yeah, go ahead.
No, so I just tack on there that I think it's funny when you said I'm not trying to sell against ourselves, and that's true. We just really passionately believe in the fact that the Flex DI product, which is a domestic filed product, you're locking your client in that premium until age 67, and then it's conditional to 70. And you have a mental nervous, a partial benefit. You have the potential to have a full own occupation definition for up to a 10-year benefit period. And then
Yep,
we're oftentimes not excluding for a majority of pre-existing conditions. It is
yep,
a kind of you get what you pay for, right? Where it's like the creme de la creme. If you're selling to your clients again, where they would be healthy, you would want them to buy the best option for them. Where of course the Lloyd's product is super strong, but I think we're going to highlight the other areas where it's a better solution for alternative options where a domestic, a decline or a pre-existing health condition for personal income is an excellent flex DI position. And I think it should be highlighted here that this is a psychiatrist who's had a heart attack, no cardiovascular exclusion. So they're really only paying less than $200 more a month to have this coverage for, uh, you know, 1,000 times longer without an exclusion and those built-in benefits. It's kind of a no-brainer when you break it down like that. Of course, the Lloyd's has its place. We just want to highlight how strong the FSL is in this specific niche.
yep. Well said. All right. If you jump to the next slide, we've already hit on a lot of these features. So I'm not going to reiterate them with the Flex DI. You do need to be aware that the benefit is graded for the first two policy years. So from day one to day 365, if they are disabled, they'd only receive 40% of the benefit. So if they had a $10,000 benefit, they're disabled, that first year they would receive $4,000 a month. Year two jumps to 75%. Year three, it's 100%. And I will say that accidents are covered at 100% day one, which is nice on this. Also, you can see, with the own occupation extension rider, we mentioned this, we can actually issue this out to a 10-year BP, which again, a lot of times they're purchasing, a policy to age 67 or to age 65. 10 isn't too that far, but it's that's going to get them quite a ways down the road. And that ONOC extension rider can actually extend the own occupation definition to that 10-year BP, where it has a 2-year built in, but you can extend it, to 5, 7, 10 years if they want. The other thing that I will point out that we haven't hit on, the maximum benefit, we actually go up to 25,000. So on impaired risk, that's a high benefit amount. And I'll also throw out there that there isn't any occupation restrictions on on that. And so what I mean by that is if you work with chiropractors, like in the domestic market, a lot of times your healthy chiropractors can, I think, only get 8 or 10,000 a month. But if you have those higher income chiropractors and their income justifies it, we'll actually issue up to 25,000 of benefit for them, because there is some additional risk associated with it. So just a little niche that we have here. But if I had to rank the key takeaways on this product, number one, guaranteed renewable. Remember, only have to reapply or only underwritten once. So if your health gets worse, you don't have to worry. And number two, the ability to issue these without exclusions. And some scenarios are the top two. So if you jump to the next slide, Ryan, we'll take a look at the Flex DI footprint. Anything in red is our Flex DI, which has better benefits and better pricing than our legacy product. But we do have a product available in all states. And so even if Flex DI isn't available, we do have an impaired risk solution available to you. So if you jump and look at this next case study, it's going to highlight common, I guess, situation that we see. A lot of physicians, doctors are part of, maybe a major hospital system. So a lot of times the quotes that we see, they do have some underlying coverage in place with the group, right? But we know the problem with, the group coverage is that it's usually got a $10,000 cap on it, right? And so the higher incomes, we can come on top of that and get them closer to protect them more of their income. And so we actually have 75% income replacement, less the underlying group long-term disability. And so this is a great way to go out and talk to clients. And if they say, hey, well, I have some group coverage that says, well, you're a pretty high income earner, it's probably not enough. And again, with this client was with type 1 diabetes, and we actually issued this with no exclusions as well. We did go with the 180 elimination period and 7-year BP. Just they like that longer BP, jump into the 180, got the price where they wanted it. So that's why we went with that. And then jumping and looking at the next case study, again, had some group coverage in force, came in on top of it. We did a 10-year BP with this particular one, and you can kind of see the difference between, going with just the standard own-off for 2 years versus extending it to 10 years. So it's basically about $50 a month to extend that to the 10 years, which, we do see a lot of people in that medical practice doing that. So just a couple case studies with the risks and what we're able to do. Non-Hodgkin's lymphoma. And, I will say, they were technically postponed by the traditional carrier. And there is an argument where they're like, well, just do Lloyd's. But it goes back to that factor that what if your health gets worse, right? Like, so let's get the best product you're eligible for today, because, a lot of times going back on those postpones, things change and they just don't get coverage. And so get the best product you're eligible for, and
And
you can
Seth,
always drop it down the road.
wouldn't you
So,
say
Brian,
even when they were re-looked at by another traditional carrier, would it not be extremely restrictive in that offering?
yeah, yep, going to be excluded. So we're protecting that condition, which is huge as well. So that's Flex DI. Again, in the impaired market, I'm a firm believer that Flex DI for physicians makes sense if they're declined due to a health condition. Ryan, why don't you take over and share some markets where IDU fits for excess coverage, business, and kind of tell them where this fits into the physicians or any of your clients that are high income earners.
Right. Well, I'm chomping at the bit. So the first thing I want to talk about is, tacking on to the personal income. And so we talked about, your impaired pre-existing sort of clientele. Maybe they're mildly impaired, so on and so forth, especially for your younger individuals who should be locked into a traditional option that's, going to be in place until retirement age. Here we're talking more about the excess, so the second or third layer of coverage. And I'm going to talk a lot today about domestic shortfalls. And this is exactly where our Lloyd's products fit in, right? So first and foremost is going to be limits. Even at the highest and best profile for a physician, you're probably looking at, I've seen 30, 40,000 a month. And when you're talking about really high income earners, they've built their businesses, they have an empire of plastic surgery offices or medical spas or what have you, where they're making a lot of money and they really do need more coverage. It's a fundamental fact that even if you're making more money, it means you're typically spending more money as well. And so your monthly bills are going to reflect similarly to a lower income earner, where they're going to eat up, a large amount of your income. And if you don't have that protected, you're going to lose your lifestyle, potentially your business. You're going to accrue medical debt, so on and so forth. And that's why it is so important to get up to at least a 60 to 75% income replacement ratio here. And that's where we're layering on top for these higher income individuals, or these individuals who maybe have a lot of income, like a chiropractor, who has maxed out. They've slotted some FSL. You know, the FSL does go up to the 25,000, but maybe there's still additional room on top of that, right? So it doesn't matter that they've maxed out in the domestic market. This is here to offer really higher limits. So we can go up to $250,000 a month. Typically up to 50 million and higher potentially on all of our product ranges. We're going to issue up to age 68. So the Lloyd's, you're also going to see it be a big play for your older individual physician clients where the FSL, Seth, remind me, it caps out at 62, I believe. So anyone over 62, you know, or even probably more in their 60s where they don't have that many times, they don't need to lock into age 67. You know, this is also going to be a great play for those individuals. And in the surplus lines Lloyd's market, this has been definitely getting more restrictive over time. So there are even less options out there in the Lloyd's space. But we're fundamentally set in very strong underwriting decisions where one of the great things about Lloyd's is the flexibility. So there is a lot of flexibility on our FSL products, especially compared to a traditional, more domestic carrier like Principal or an Omaha Mutual, for example. Lloyd's is incredibly flexible, and that's where we come into play to help walk you through that, guide you, help craft different options, because we can do monthly benefits. We can also do lump sum benefits, and then we can do a combination of monthly followed by a lump sum, which is a plan design I really like, especially for your higher income earners. You can craft, for example, a lump sum that fills in the gap to age 65 once their monthly benefits have been exhausted. Or maybe they have maxed out and they're at a 60%, but they want something more catastrophic where a lump sum is going to come into play, where they've been deemed permanently totally disabled and unable to perform their job. So these are all own occupation definitions. The maximum is a 5-year policy term, so they do have to go through a renewal process. And that's why we really are focusing more on the less impaired, because you know, the worst thing you could probably do for your client is set them up where in that renewal, you know, they've been issued a policy and then the next policy they're getting issued is restricted. The rates are jumping up. There's new exclusions. That's a really harder sell. And it can be an area where you can lose your client's trust. With our renewal process, we're trying to streamline that as much as possible. But that's why we're highlighting this on more of the healthy clients and really trying to push how beneficial the Lloyd's product is for the excess needs, right? So we talked about the domestic carrier limits. There's also potentially business size, which is going to come into play with our business products. Underwriting restrictions, so the flexibility. We're always looking to avoid declining a client. Instead, we're looking to rate, writer, or exclude. And we have a lot of mechanisms to do that. So on the flex, we often don't exclude for diabetes. On the Lloyd's, we will exclude for diabetes, but we do have other options where we remove that exclusion and they get a more dialed back plan design with some ratings, right? So there's a lot of negotiation and availability here with our underwriters and our consultative sales approach to craft an option that works for your client's needs, right? So whether that be for excess or other types of situations, especially in the business product section. These generally go up to a 5-year benefit period, and elimination periods most commonly are 90 days. Most clients opt for the 90, but we can go up to 730 days here. We have residual and COLA riders. So the residual rider and COLA rider, they are purchasable, where on the flex product, that mental nervous and that partial is already baked into the premium. So our residual, it does require a loss of your time to do your job or your ability to perform the duties for your job, and a loss of income. And then we do go up to a 75% replacement ratio. Again, this often comes into play when you're looking at underlying taxable like GLTD. And one of the things that we also focus on a lot, knowing that the DI space is maybe a little neglected. Oftentimes, clients and agents will get discouraged because of the restrictions. or worry about being declined, not knowing how to find a solution. So when you're running up into any kind of barriers from a traditional carrier sense, you should be thinking IDU and risk, because more often than not, we're going to have a solution that answers those issues, right? So whether that's the occupation isn't something they're looking at, their business size, their income size, maybe it's a net worth issue where they have too much net worth and a lot of domestic carriers aren't interested. They think they can self-insure. Or it's a participation issue where they only want to go up to a certain benefit amount. These are all areas where we're going to be able to slot in and find you a solution for your clients. And oftentimes, there's also a lot of cross-sell opportunity here. And that's something I really want to highlight is when you're talking to your clients who are these higher income earners in the physician space, particularly, a lot of them are going to be leaders or owners of their own practice, key person type situations where you have the opportunity not only to talk to them about their excess, right? So you're talking to them about their DI needs and you're looking at a domestic option and it's going to cap out where they're at a 30% replacement. Well, this is an opportunity to talk about the excess and go ahead and get that in front of them while you're having that conversation. But not only that, there's a discovery of, do you own the business? What do you do in that business? Are you a key individual, an executive, a decision maker there in that space? So there's a lot of opportunity for cross-sell here, especially amidst the Lloyd's products. Another thing I really want to highlight, and I should have highlighted here on this slide, Seth mentioned, we don't require medical exams, right? So your client doesn't have to jump through hoops. Doctors are hard enough to get on their schedule as it is. They don't have to jump through hoops to get a medical exam, schedule some kind of paramed blood, urine. We're doing our underwriting via medical records that we'll pull on the behalf of your client. And a lot of times when we're dealing with these healthier individuals, maybe they've already gone through a domestic DI underwriting process. We can use those, or we might look to waive them all together if we feel like we have all the information we need and it's a really preferred risk. So we are trying to make the underwriting process as painless, streamlined, and simple as possible, because we do know that's a big pain point in the DI side of things. So one of those programs that we've designed is our medical residence program. And there's a lot of, domestic carriers out there who have these resident programs, and that's great. Those clients should absolutely apply for those. Our medical resident program was designed for the individuals who maybe it's not provided through their hospital or their residency program. Maybe they would have to go purchase it on their own, but they have pre-existing conditions and now they're getting declined. Here they could slot in a medical resident program where we have up to $7,500 a month. Some of the specialties are going to be lower limits than that. That is dependent on the specialty. And we can issue a policy for 3 years while they're going through their residency program. And then the thought here is an upsell opportunity where you now have given that client who is just starting out in their career an excellent DI solution that's going to get them through till when they're going from making 60,000 to hopefully 260,000 plus, right? Where there's a huge jump in income here, and they're still going to need more insurance. You're able to lock yourself in with that client early on in their career. And then there's an upsell opportunity where maybe you're looking at, hey, there's a Flex DI, or hey, there's also a Flex DI and a Lloyd's option here to play. We do apply a relations to earnings clause so that the benefits don't exceed 100% of their income. And this is available in all the states we write in except for New York, and then Alaska, Kentucky, and Vermont. Montana and Vermont are all states that the Lloyd's product isn't available in. So there's very few states that we don't offer this. So it's really broadly available. Another area that we see a big uptick in is your individuals who are foreign, right? So they live in another country, they're a citizen of a different country, and they've come over to the US to do their medical schooling and go to their medical residency. well, maybe they don't have an option there because they're going to be precluded from any kind of more traditional residency program. This is also available to them. So there's these areas where if you, again, find a stumbling block, IDU probably has a solution here. So again, this is going back to making things easier, simplifying the underwriting. We're waiving all the financials and issuing these with just an application and the medical records. Another simplified program we have is our top-up program. So I spoke earlier about when you're talking to your clients and you're looking at maybe an IDI solution to slot on top of their GLTD, for example. When you're going through that process, that is the best time to grab that client's attention and talk to them about excess coverage on top of that. And we're going to have a case study that highlights one of those really strongly here. So our top-up program is going to streamline with no medical underwriting because we're essentially piggybacking on the domestic carrier non-can issued policy. So as long as they're under age 60, they've been issued that non-can policy within the last 6 months, we're going to be able to automatically basically issue them up to 25,000 depending on their income level here. Again, this is that 5-year policy term, 5-year benefit period, and it is available to all market segments. As Seth had mentioned early on, we're really highlighting physicians, but this is available to your executives, to your gray collar, your entertainment type individuals who are already getting a non-can DI policy and will need more additional benefits to get them up to that ideal 65-75% income replacement ratio here. And then all we use other than the non-can policy is our short form application, which is just a couple of pages, and then the prior year tax return or pay stub to gauge their financial level there. So it makes it super, super easy to go ahead and get that excess coverage without your client doing all of the full application, scheduling a paramed, doing all their financials, so on and so forth, where they're probably a little bit exhausted from going through the process already. This is going to smooth that runway into their next policy here. So it's definitely something to keep in the back of your mind as you're talking to your clients and you're at that sales point already. Right. This is our personal income case study here. So this is a plastic surgeon, obviously making quite a lot of money. So even with the GLTD and the IDI, they're only at a 30% replacement ratio at that 1.2 million income mark. So we came in and did an additional 40,000 a month for a 5-year benefit period with all the riders. So they have a total aggregate potential of 2.4 million. And that's going to be really meaningful when you think about that, talking to that client, you say, could you live on 35% of your income if this happened tomorrow, right? The answer is probably no. And this is just a monthly plan design, but I had kind of mentioned earlier our combo plan design, where this individual, he's 52 years old, so he has a number of years left until retirement age. And what happens if he, became disabled and then he exhausted his monthly benefits? Well, then he's back to that 35% where we can tack on a lump sum benefit. And one of the sales thoughts that I really think is impactful here is monthly benefits are going to be for your daily living, your bills, your car payments, your mortgage, your student loans, what have you, where the lump sum can come in and give that client sort of a nest egg to start again, whether that's going back to school, starting a new business, or reconciling some debts that maybe have piled up, where it's a debt consolidation sort of a plan. A lot of physicians have a lot of student debt. So what happens if they became disabled and then they were never able to go back to that job? Right? They still are going to have those debts lingering over their head. So the lump sum is a really interesting and unique aspect to the Lloyd's market that I really like in a combo plan design, especially for personal income needs for your higher income earners. Then we're going to jump into our business products here. This is the key person coverage. So often we see key person life being sold and the DI side getting neglected. And a lot of times it's agents thinking that this product just isn't available, whether that's because a domestic carrier won't consider their occupation or the size of the business. Where we have that key person solution that can go up to 10 times that key person's income. That key person can also be a business owner. They could be 100% business owner, or they could have no ownership whatsoever. So there's a ton of market opportunities here where you're looking at maybe a medical or an occupational decline, like I spoke about earlier, or maybe you are able to get a non-can DI traditional solution. Those usually go up to 750,000. But if this is the leader of the business and they're pulling in millions of dollars to that practice, that's going to be a drop in the bucket compared to what that business would actually need. And one of my favorite things, so key person is low key, I'm going to sound like an insurance nerd, one of my favorite products because it is so flexible, where the other business products are going to be tied to either a contractual or a specific financial need. The key person benefits are extremely flexible and can be used however the business sees fit. So that might be recuperating losses. That might be hiring a new doctor to come in and start running the business or taking on clientele. The succession planning costs or severance benefit type costs where you had an agreement with that individual that if they left, the business was obligated to pay them a certain amount of money. So this can be used as the business sees fit. We do not have any kind of specifications. The benefits are paid to the business can use them as they need. And then lastly, most of these for the physician market are going to be individual, fully underwritten. But we do have the ability to offer a GSI guaranteed standard issue option here. The GSI market, especially in the Lloyd's space in regards to physicians, has really dialed back. So the available groups are going to be looked at a lot more restrictively, but it is still available. So when you're talking to a larger hospital, maybe it's they have a bunch of surgical and sort of executive type leads who have physician roles, where they're looking to offer key person coverage to all of those leaders of that hospital. We're able to look at a GSI solution on an employer paid 100% participation basis. So there's no voluntary options here for any of our business products. This is all going to be mandatory coverage, but as long as we have 100% of the defined group, and typically speaking, you're going to be looking at a minimum of around 10 lives. There might be some availability there where that we drop that number if their specialty, for example, is a lot less surgical or a lot less invasive. So that is a flexible number there. But typically you're looking at least 10 lives and, you're going to want ages under age 60 for sure, right? So we're looking at the profile of the group. And if the profile is beneficial and it's an employer paid option, we can go with a GSI solution here for any of our business products. So that's key person, loan indemnification, BOE, or buy sell. So there's often times when you think I'm going to have to try to get all of these doctors to go through full underwriting with a GSI. It's an employer completed application and a group census, and then it's straight to issuance. So the individuals who are being covered by this product actually aren't involved in the underwriting and don't have to jump through any hoops at all, which makes it incredibly easy to implement.
Ryan, just for a point of clarification, I know you mentioned, I don't want this to get lost, but you mentioned the restrictions for physicians specifically, because
Mhm.
that's what we're talking about today. But does that mean that other occupations like a lawyer group might have a little bit more not as rigid?
Yes, well, no, you
Okay,
hit the nail on the head there,
and
Sam.
we
Yes.
don't have to get into it all, but I just want to make sure that the
Yes,
audience is aware that
yes.
physicians specifically have the restrictions where we
Yes.
have a lot more flexibility on the other occupations. But
Absolutely. We have a
yeah,
lot more flexibility, a lot more availability for the like white collar, more preferred type occupation profiles. The reason I wanted to really highlight this, Seth, is also that you're not going to find a lot of Lloyd's cover holders that are even going to entertain offering a GSI option. So even though it is a more specific pool that we're looking for on that group, it is still an option out there. So if you even have a client who has multiple different business owners, it's a larger practice, they have a buy sell type or key person type need, it is worth asking, coming to us and saying, hey, is this something you guys would consider for GSI? Because if you don't ask the questions, you won't know if it's available. And I really want you guys to understand that we're here to be consultative. We're here to say, you're trying to brainstorm, maybe is a BOE option the best? And we look at an alternative business solution here. Which leads me into the key person case study. So this is an OBGYN owning her own practice. She got key person life, but there was really no DI options out there. And because this individual owns their own practice, she was concerned about sort of a business overhead expense need, where if she was out just in the short term, how would the business survive? Because she really is the rainmaker. She is the one bringing in the clientele. She's the one that people are coming to see and making appointments for. So we did a plan design that was a combo of $75,000 a month after 180 days. That pays out for 2 years, right? So you're covering the business, sort of any kind of financial needs that they might have in the short term. And then if that individual isn't able to recover and return to their business, they have the lump sum on the back end that's going to help ease that transition, right? To help that business stay afloat, stay soluble. It is a great solution, especially for your business owners who might not have a lot of other doctors or physicians, or maybe they're really holding the fort down. They're really important to that practice, and without them, it would suffer. We also oftentimes do just a lump sum plan design, which is more common for your key persons who are not necessarily business owners, or who might have other individuals that could, again, hold up the business, keep it afloat while they're figuring out if that individual is going to be able to recover and return to work. And then lastly, here we have the buy-sell coverage. This is great, again, for, there's a bunch of domestic shortfalls here. One of the biggest ones is a one-way buyout, or your family-owned business. We see this a lot, especially in the physician space, where it's a mother-daughter, a father-son, husband-wife, sister-brother, what have you, where they own the business together. They're completely precluded from finding any kind of traditional options. That's where we're going to come in and be able to do $1. Another big area is the percentage of ownership. So if someone's more than a 51% owner, or usually I think it's below a 5%, they're not going to have any options. That doesn't mean the business isn't financially exposed, and there's not a very good reason to go out and find coverage, which would be through the Lloyd's space here. And it's really important as you're talking to your clients to do these kind of discovery questions, these considerations for your business owners. And certainly it's very applicable to the buy-sell, because again, buy-sell life, very, very common. Buy-sell DI, definitely trickier. Where you have options with IDU here, again, up to $250,000 a month, 50 million. I mean, it's very rare that you're going to stumble across a benefit amount that we wouldn't be able to provide. So these considerations, talking about them, about what's their plan, what happens if they suddenly go out, how will their business transition? Do they have a plan? Do they have a buy-sell agreement in place? Oftentimes we're quoting these individuals where they're still crafting a buy-sell agreement, where they're trying to design the buy-sell agreement to fit with the insurance. And that's a great area to start at the ground, whether they have the buy-sell agreement in place or they don't. That's the time to start talking to them about what is their plans, what are they thinking long-term longevity for that business, and how would that business thrive if they were to need to take on a great amount of debt, right?
Yeah, I love this opportunity, Ryan. I just posted on LinkedIn actually this week. There's an article about buy-sell agreements, and like the first paragraph said, buy-sell agreements it ultimately set the term in the event of death, disability, and retirement. That's what it said. And then the article mentioned life insurance probably 10 times. Guess how many times it mentioned DI?
0?
Zero. And but in the very first paragraph, it said buy-sell agreements include the terms for death, disability, and retirement. Mention DI, zero life insurance, 10 times. Anyways,
Right.
go on. Just want to throw that out there. I think there's a huge opportunity for agents and
Yeah. No,
yeah.
absolutely. And it's really important because, these individuals that we're talking about, these physician markets, not only have they gone through an immense amount of school, an immense amount of discipline, then creating their own practice and really needing to think about the solubility of that business if something were to happen that they didn't die, but they just became disabled. How is that business going to be soluble? What will they plan on doing? So whether that's a buy sell, a key person type solution here, this is 100% owner of a chiropractic business where they've had a employee who's another chiropractor at that business for a long time, and they were going to sell when they retire. But they do need to plan on what happens if that owner becomes disabled. And they have that buy sell agreement in place. Now that business is going to have to take out a lot of debt to buy them out of that $1.2 million benefit. That's a total business value there. So really, we're covering from dollar one on a one-way buyout for 100% owner on a chiropractor. And this is something I literally quoted last week. I mean, obviously names have been changed with all our case studies to protect client, privacy. But this is, benefits paid to the business should that owner become permanently, totally disabled. Before, again, they were planning on selling that business to the individual. So not only are you protecting that business that you've built, and the solubility of it, there's also a great, again, cross-selling opportunity here for that business owner to say, hey, what happens if that key employee who's supposed to be buying me out becomes disabled and isn't able to continue being a chiropractor? Are they still going to be interested in buying the business? Most likely not. They're going to have to pivot. And so that's a great opportunity to say, hey, you also should look at taking out coverage on that key individual who would be buying you out. So again, there's a ton of discovery and opportunity to be farmed in these market segments. And then just really as a highlight here, we have the loan indemnification and the BOE that we didn't go into a great amount of detail, but I did want to mention. And again, key person being flexible, the business can use those benefits however they see fit, including any of the other business needs. The other products are designed, again, specific to a buyout agreement, a loan indemnification. We see these products very common, especially in the physician segment, because they're often taking out business loans. Maybe it's to buy new equipment for their practice or to open their own business. They're purchasing a practice, so on and so forth, where even if they're healthy or they're unhealthy, the bank who's providing that loan is going to require DI to indemnify that loan. So it would be great if they have a domestic option, but oftentimes we're seeing where a domestic option either isn't available or is super limited in how much coverage it can provide, and it's just not meeting the bank requirements on a loan here. So these are tailored to the individual loan. Usually they're going to be the monthly benefit followed by a lump sum if need be. We're also very flexible on this front where maybe it isn't a bank, but it's I had a father his son was buying the practice and he needed to take out a loan to pay his father. There is absolutely no domestic option out there where we were able to provide a loan indemnification to the son as he's trying to purchase the business from his father over time. So these are going to be non-traditional type loans. Again, these are great with the domestic shortfalls where you have inflexible, benefit structures, untraditional type situations, family type situations, or pre-existing conditions, right? And on the BOE, this is to cover the rent, keep the lights on, the electricity, make sure your support staff still gets to collect a paycheck. If you were to become disabled and not be able to go into that business and perform the duties that you need to do in order to bring in the revenue here. So the BOE is going to be specific to a list of overhead expenses such as, rent, like I said, support staff kind of employment. And a lot of times we're seeing these physician practices that have really, really large overhead needs, and the domestic market is maybe providing them 30,000 where they need 100,000, right? So this is a huge play, especially for the excess or again, a decline in your pre-existing conditions, or maybe it's an occupation that just isn't going to be considered there. So these are lots of opportunities. As soon as you run into a barrier anywhere, know that that's not the end of the road. It is just the next segment to talk to Seth and I. And I really hope that you guys will come to us with any kind of questions. Certainly, even if you have, and I got a guy, I'm thinking this, that, we can help you craft some different options to present and really hone in on what that client needs.
Yeah, well, great job, Ryan. And I know that is a lot of information, but as Ryan mentioned, you don't have to be an expert. That's what Ryan's here for. That's what the rest of our sales team is here for. And so, I think one of the value props that we bring to the table is the consultative approach that we take. And if you have a scenario, you have a person, we're gonna, maybe ask some additional questions and then point you in the right direction. And then the second thing, remember that we have the Lloyd's option, for the excess, for the business, etc. But then we also have the impaired risk product, which I think is great for those physicians that have pre-existing health conditions. So appreciate everyone's time today. If you have any questions, feel free to give me a call or Ryan a call. Ryan's email is ryan.lobo@iduinc.com. So feel free to reach out and hopefully we write some business together. Thanks, everyone.
Great. Thanks so much, everyone.